The minutes of the latest Monetary Policy Committee are out, and a couple of things stand out. One is that the governor and most of the members of the committee have defended the longish accommodative stance which was given in the statement. The committee, if you remember, had said that we have decided to remain accommodative this year and into the next financial year. Most of the members have defended it, and there was one dissenting member for the accommodative stance, and that was Dr. Jayant Verma, the newly incorporated external member. He appears to have dissented more on semantics, but let us see. He has dissented saying that the MPC shouldn't say it has decided to be accommodative into next year, but must say that it expects to be accommodative through to next year. That would be more true to its character. These are the two points that stand out, but it also raises several questions which would be raised anyway. One, what are the key takeaways in terms of the character of the new MPC? Because there are 3 external members who have been newly incorporated. 2, what are the takeaways for the debt market from this minutes? Last time, if you remember, the minutes had kind of set a cat among the pigeons, and we saw yields rising after the minutes. And third, what happens if inflation increases and doesn't go according to the trajectory given by the Reserve Bank? Will the minutes now look out of sync? There are a bunch of other questions that rise, and I have an extremely eminent panel of economists and bond market experts to answer some of the questions. I have with me Dr. Sabisa Chikar, the RBI Chair Professor at the NIPFP, National Institute of Public Finance and Policy. We are also joined by Soumya Ghosh, the Group Chief Economic Advisor at SBI, and R. Shivakumar, the Fixed Income Head at Axis Mutual Fund. Gentlemen, thank you very much indeed for joining me. Dr. R, let me start with you. Well, what do you make of Jayant Verma's statement that the MPC shouldn't say that it has decided to remain accommodative through to next year, but that they should have said they expect to be accommodative? Is that just a semantic usage, or are you reading more into it?
Right. Lata, you want me to answer, right?
Yes, Mr. Kar.
Yeah. So, although, this is very interesting. It seems like semantics, but if you read between the lines, I think there's an interesting issue here. On the one side, Dr. Verma has himself rightly pointed out that the credibility of the inflation fighting credibility of this committee depends on whether it commits itself to fighting inflation above everything else. And so he is saying that if inflation comes back, how can we say that we'll still keep accommodative stance? So he's saying that the inflation fighting credibility is in question. But on the other hand, you also have the credibility of policy announcement. That's another issue with monetary policy, which is usually called the time inconsistency problem in the monetary policy literature, which says that the private agents will only trust the RBI's current policy stance if the RBI comes out with a very strong forward-looking statement. If it changes from changes to expected to, it's not coming across as strong as it currently sounds. So I think there is a trade-off between these two credibilities, and the MPC is the difference in the visions among the MPC reflects this.
Fair point, sir. Actually, that's important because I began by saying that the previous set of minutes had exacerbated the market's fears, or at least kindled market fears that the MPC is worried about inflation, and we saw yields go even to 6.2. Of course, there were other reasons. Well, let me first get that point out of the way. Shivakumar, how will the bond markets read it? The bond markets have been extremely benign at the close of the week, with bond yields dropping to 5.85. I think that was because of another OMO and the current OMO being very successful. But after these minutes, will the bond market continue to remain benign?
Hi, Lata. I completely am on board with that. I think Professor Verma's point is a little bit nuanced than just worry about inflation. I think he's worried that the IMPC is not giving enough of a guidance enough to flatten the yield curve. I think he believes that the yield curve is too steep, and a part of the reason for the steepness of the yield curve is that the market doesn't believe that the RBI will keep rates low long enough, and therefore the yields are too high. Longer term yields are too high. So his point, I think, is that he's actually dissenting. I don't think he's dissenting to be hawkish. I think he's dissenting that the MPC is not dovish enough. It's not giving a long enough guidance. His guidance is too short. The second point, I think, is also that the governor's statement says that the MPC should maintain accommodative stance as long as necessary. So while the MPC statement as agreed seems to suggest that they have decided this for the next 6 odd months, I think the governor and Professor Verma both come from the point of view that perhaps the language should be more to the likes of as long as necessary, which is, I think, a stronger statement than this time-bound guidance.
Okay, so you expect yields can go even to 5.8 listening to this?
I would not be surprised. And I think if the MPC genuinely comes across to say that we are here lower for longer, it should suggest to the market that long-term yields should drop. Now, of course, on Monday morning, we should see how the market genuinely reacts to this. But my belief is that markets will take this very positively.
Okay. Soumya, would you agree? I just want to get this market point out and then get to more economic policy questions. But would you say that this is the minutes are as dovish or more dovish than the statement? Is that your key takeaway?
Yeah, I think, Lata, I would tend to agree with the point that this policy, if you look into the minutes, this is more about communication, and it is more about communicating to the market that we will stay on hold for a longish period. And I think that has been perfectly justified by most of the MPC members. And the important point is that the use of the word decided and the use of the word as long as it takes is actually bears remarkable similarity to what Fed also said in 2012 when there was a market demand that instead of saying that for a long period, you specify the period. So when you say that we are going to stay on hold for a longer period, maybe since the mid of next year, what the RBI is doing is actually anchoring market expectations, and that because ultimately at the end of the day, monetary policy is all about managing expectations. And just if you look into for example, if I just digress a little bit, if you look into the auction results today, that clearly indicates that the auction expectations is now more aligned with what the RBI would term in terms of the expectations of the yield movement. I think that's the bottom line of the MPC minutes which we see today.
All right. Okay. Well, in that case, Dr. Sabyasachi, would you say this MPC, now I'm inviting your comment on the 3 new members, is more aligned? Are they all dovish, so to speak? Last time we had Chetan Ghate, who was perhaps a little more hawkish, and certainly Viralacharya.
Yeah. Let me just touch upon the one aspect of the last question, and before I go to this question. So the issue is, in fact, if you read Dr. Verma's minutes very carefully, in a sense, he has been both hawkish and dovish, because when it comes to the time horizon, I completely agree that he is more dovish. He's saying that, the forward, this thing has to be for a longer period, because, but when it comes to he has also made the point that monetary policy has to be data driven. And if the data changes and if inflation comes back, there is no way we can stick to our dovishness. So that's the hawkish part of it. I mean, it's relative.
Yes, the word expects is less dovish than the word decides. I take your point.
So anyway, coming back to your question, I think, first of all, we need to give this committee a few more meetings before we can actually decide who's more hawkish or dovish. Frankly, given the current situation with a minus 10% growth rate that they're forecasting and 4% inflation in the next year, the current policy cannot be really called dovish. I don't see any other possibility. I mean, if you are not dovish with minus 10% growth rate, when will you be dovish?
Fair point.
So let's look at the future, and we'll get a sense of who's more hawkish and dovish.
Oh, yeah. Okay, so you will hold your judgment on that. I'll get Shivakumar and Soumya also on this and then go into a break. Soumya, would you say that they're largely aligned and more dovish than the previous?
I think as of now, you don't have anything on the table. And just to take one more point, I think a monetary policy, the word of decision and this expectation has created a lot of noise. But my sense that the monetary policy sits to decide, because it sits every 2 months. So if every 2 months, it cannot be an expectation. So from that point of view, I think the decision word is justified. But my sense is that let it give some time. But on the face of it, if I go to the MPC minutes, it seems to be a little bit dovish, because there are members who has been on the dovish side if you look into the statements and the articles which has been occurring in public domain.
Okay. Shivakumar, would the title of your MPC minutes review essay be more doves than hawks than the previous MPC?
I think it's more of a do what it takes, but don't expect a rate cut. So it's basically an MPC which has decided that we will give you everything you want. You want more OMOs, you want SDL, OMOs, etc. And keep liquidity easy, everything, but don't expect necessarily rate cuts.
Why do you say that? Why do you say that? Which sentence gave you that confidence?
I think the point that which was made by Mr. Kar also earlier is that I think there is an underlying concern that if inflation doesn't come down quickly enough, they may not have room to do too much in terms of rates. So I think a lot of the current the outcome, both in terms of the MPC but also the actions of the RBI, is more about yield curve management and expectations management than about actual rates.
Okay.
So it's more. I think it's a MPC which is signaling that rate hikes are off the table. As long as you're an accommodative stance, rate hikes are off the table, but not necessarily any more cuts. I think there may be cuts to come, but I think they are setting up expectations for, I think, a lower for longer rather than anything else.
Okay, well, so 2 takeaways from my experts at the moment, that the minutes drive home the point that the MPC wants lower for longer as a message to be communicated. And the second takeaway, yes, they are doves. This committee seems to be more dovish than the previous, but at least 2 of the experts, Sabyasachi Chikara and Shivakumar, want to say they are dovish for now, but they will be data driven. So not a very conclusive, more dovish than previous kind of comment from my experts. A quick break, but I'm going to come back and ask them a what if question. What if inflation doesn't dip below 6 this quarter? What if it was staying above 5 next quarter? Those questions after this break. Welcome back. The minutes of the Reserve Bank's Monetary Policy Committee meeting on October 9th are out, and we've been discussing with Dr. Sabyasachi Chikara of the NIPFP, Kanti Ghosh of SBI, and Shivakumar of Axis AMC, what they have made from the minutes. 2 important conclusions. One, that clearly the communication of the minutes is that the committee wants to keep rates lower for longer, emphasize it so that the rates are better transmitted into the market. And secondly, that the new committee, perhaps, there are 3 new members there, is perhaps more dovish than the previous, but the caveat is that they may change their mind when they see different numbers. Okay, but will they see different numbers? We have seen some unseasonal rains, and the last 12 months average inflation is well over 6.5%. So, Soumya Kanti Ghosh, what is your expectation? Are we going to have another quarter of, that is, October, November, December, also averaging above 6%? Is that your base case?
Yes, Lata, I think right now the inflation scenario actually is not at all looking promising. The unseasonal rains actually where the inflation is supposed to dip from October onwards, but as of now, we believe that the inflation will continue to stay above 7%, at least for the month of October. So that means that the possible decline in inflation trajectory, which was expected from December onwards, that could be further delayed. And the full year average now looks perilously close to 6%. So I think if an average close to 6%, that is really a matter of concern. So having said that, I think one fundamental difference I'd like to point out with the MPCs these members have emphasized, and which is going to likely to drive the policy decisions of the RBI, is that these decisions, if you look into the minutes very carefully, the external members have actually discussed about liquidity, about yield curve movement, and other things, unconventional policy measures, which were perhaps absent in the last last time when they were external members. So from that point of view, it gives you a clear indication that while rate cut may be off the table, the RBI will still be looking for unconventional measures so as to keep the yield under control, so that it can manage the huge amount of borrowing which is likely to which have hit the market, and possibly there could be an overhang of that.
Okay, actually you're taking the issue a little slightly different. While you say, of course, that inflation will be higher, Dr. Sabyasachi, what Soumya is saying is that this MPC is also discussing financial instruments. Until now, that was not seen as the purview of the MPC. It is supposed to have only one tool, the repo rate. It was not usually commenting on liquidity instruments. Do you think this MPC has appropriated more area?
Well, right. I think, when any central bank or the MPC says something, I look at it as a signaling device. And I think when they are speaking about these other factors as well, I think they are signaling something. I think mainly the success of monetary policy depends a lot on fiscal monetary coordination. Right now, we see very little fiscal, stimulus from the government. But unless there is, that kind of a stimulus, then conventional or unconventional monetary policy by itself will probably not be able to, solve the problem.
Okay.
So I think, amongst other things, they are also talking about the recovery of the economy.
Yes.
And I see this as a kind of signal to the government to start making some fiscal efforts, because the government has said that they will wait till a certain level of recovery,
Yes.
a certain level of. So I see all of this as signaling.
Okay.
On the
Fair
RBI.
enough. Okay, Shivakumar, I wanted to ask you something else on inflation. Of course, this is an unadulterated dovish signal that is coming, and all of you are admitting that. But if you're going to get one reading, which is 7% in October, do you think the bond markets may ignore all this communication?
No, I think the bond markets will look at what RBI will do over a period of time rather than just reacting to a specific data point. To be sure, it looks like the members in the MPC are expecting inflation to start moderating from the October print, which is to say in the month of November.
Yeah, and if that doesn't happen is what I'm asking, because
Yeah.
a lot of people are now worrying that the late rains are going to keep why going to? I can see it when I go to the market, have kept vegetable prices very high. So will that inflation print, spoil all the good work of the MPC minutes?
Yeah, so one of the interesting things that you mentioned, which is about food price inflation, if you see a lot of the food price inflation is really the gap between CPI and WPI, which is in a way what the MPC is talking about, the retail margins, the expansion of retail margins because of supply issues and the surge cost for consumers, etc. So in that sense, this is seen to be a passing, meaning as the system goes into unlock, this premium that you're seeing between CPI and WPI should narrow, and therefore, even if WPI increases a little bit, you should actually see overall inflation drop. And I'm sympathetic to that point of view. I think over a period of time, we should see CPI decline. Now, whether it declines down to 4%, which will give MPC a lot of comfort, or whether it stays above 5%, I think will be a crucial factor, but it will be a factor for next year, not this year.
Oh, I expect you to be sympathetic to that point of view, because we are all drawing a salary, and perhaps as a fixed income guy who has probably made money for his AMC, you're also getting variable bonuses. But you think of a pensioner or think of someone with a fixed income and potatoes and onions selling at over 50 rupees a kilo, there will be much less sympathy for this difference between WPI and CPI. No, Shivakumar, 1 minute. Let me just get to another point that I wanted from Sabyasachi and Soumya. Mr. Kar, do you think that now the MPC is very clearly interpreting that its mandate is not 4, but its mandate is between 2 and 6?
Yeah, so I think, in fact, as far as comfort zone is concerned, it seems to me that the mandate is between 4 and 6 rather than 2 and 6. Okay. And I don't think the MPC is going to try and drag down inflation rates below 4 to have an average of 4 over the long run. So their focus is right now on growth, and so inflation, as long as it remains within the corridor, I think they'll be happy with that.
Okay, Soumya, last thoughts from you. Any other key takeaways from the minutes?
No, I think I broadly agree with the points made. And regarding the just one point I would like to highlight is that regarding the gap between the CPI and WPI, a lot has been said. But if you just do one simple extrapolation and replicate the WPI using CPI weights, the gap between the two actually narrows down to around 40 basis points. So I think there is a larger issue of increase in food prices, and which we cannot neglect. So this is the point. The second point, which you rightly mentioned, I remember that you had also written about it, I think, regarding the fact that the RBI is now clearly targeting the inflation throughout the cycle rather than at a point in the cycle.
Okay.
And there are numerous examples like the Reserve Bank of Australia, the Fed, which does the same with remarkable success. It remains to be seen whether in India, where food still has 46% weightage in the overall CPI basket, the RBI is able to achieve that or not.
Okay. Well, gentlemen, we are out of time. Thank you very much, Sabyasachi Kar, Soumya Ghosh and Siva Kumar. The key takeaway is that the big communication from the minutes is to keep interest rates lower for longer. And to that extent, the new MPC members, the external members, appear to be more dovish. There are more doves in this MPC. But the important caveat is that they do sound that they are data-driven. And the data, the incoming data, the nowcast that we are getting about inflation for October and November appears to be pretty ugly. Definitely not going towards what the Reserve Bank's trajectory is. So all this good communication may come undone going by the unseasonal rains and the prices of vegetables. But that discussion for another day. Thank you very much for joining me in this special session discussing the minutes of the monetary policy meeting. Stay on with CNBC TV 18.